There is a moment in financial history when mathematics stops being theoretical and becomes violent, a specific point where the leverage that created paper fortunes transforms into a liquidation engine that destroys real wealth. It happened in September 1929. In less than 3 years, 89% of the stock market's value did not just correct, it vanished. To understand the scale of that destruction, imagine if $28 trillion of today's American economy were wiped off the ledger overnight. Most historians call this a panic. They are wrong. Panic implies an unpredictable emotional reaction. What destroys markets is not human emotion, it is mathematical necessity. It is a 7-stage sequence that plays out with mechanical precision once specific conditions align. It executed its code in 1929. It repeated in Japan in 1989 when their market collapsed and never recovered. It nearly shut down the global financial system in 2008. And every single time, the people living through it believed they were different. They believed that new technology and sophisticated policy had made crashes obsolete. They were wrong. Right now, in 2025, we are in stage 5 of that exact sequence. This is the crack. The moment when leverage is at its absolute peak, just before the mathematics of forced liquidation take over. The timeline suggests we are looking at a catastrophe within 18 months. This is not prophecy, this is pattern recognition. And once you see the pattern, you cannot unsee it. The crash, when it comes, will not be your fault. But surviving it is now your responsibility. Let us open the file. To understand the mechanics of the collapse, we must first analyze the architecture of the trap. It did not begin with a bang, but with a policy decision. Let us take you back to 1920. World War I had ended, and the United States emerged as a creditor nation for the first time in its history. However, the industrial capacity built for total war suddenly faced a vacuum of peacetime demand. Factories that had been running at maximum output for military production stalled. Unemployment spiked. Commodity prices cratered. The economy entered a sharp, brutal recession in 1921. Under normal historical conditions, this recession would have cleared out inefficiencies. It would have reset the baseline, but the Federal Reserve, an institution created just 7 years earlier, in 1913, was still learning how to wield its power. They decided that the pain was unnecessary. They decided to stimulate. This is stage 1. Easy credit creates artificial prosperity, but the true origin of the disaster has a specific date and location that few textbooks mention. It happened in July 1927, at a secret meeting on Long Island. The heads of the major central banks, Montague Normand of the Bank of England, Hjalmar Schacht of Germany, and Charles Rist of France, met with Benjamin Strong, the head of the New York Federal Reserve. The European bankers were desperate. Britain was trying to return to the gold standard, but their economy was too weak. They needed the US to lower interest rates, to force capital to flow back across the Atlantic to London. Benjamin Strong agreed. In a fateful decision that would doom the next decade, he decided to give a little coup de whiskey to the stock market. By 1924, and aggressively again in 1927, the central bank slashed the discount rate. In the context of the era, this was practically free money. Commercial banks, taking their cue from the Fed, began lending with unprecedented aggression. This influx of cheap liquidity did something far more dangerous than just boost stock prices. It fundamentally rewired American human behavior. For generations, the economic logic was simple. Consumption required savings. If you wanted a radio or refrigerator, you saved capital, then you deployed it. But in the Roaring '20s, that logic was inverted. Installment plans flooded the market. Suddenly, you could have the asset now and pay later. Here's what nobody understood at the time. When credit becomes too cheap for too long, the incentive structure of an entire civilization shifts. Why save for a purchase when borrowing costs almost nothing? Why invest in a productive enterprise? A factory, a farm, a logistics network? That takes a decade to generate returns, when you can use cheap leverage to speculate in assets that double in months. The economy moved from production to speculation, from patience to leverage. By 1925, the trap was set. The factories were humming again and cities were growing, creating a facade of real progress. But beneath the surface, the foundation had been replaced. The prosperity was not being driven by income or savings, it was being driven by debt. This was the financial carnival where borrowing was relabeled as wealth creation. The easy money policy had successfully cured the recession of 1921, but in doing so, it had introduced a lethal virus into the system, a virus that feeds on leverage. And once the population tasted the easy returns of 1925, they naturally looked for a way to accelerate the process. They did not just want to borrow to consume anymore, they wanted to borrow to gamble. The foundation was laid. Now they needed a machine to multiply the risk. With the psychological barrier to debt removed, Wall Street introduced the mechanism that would weaponize it. Margin lending. This was the original financial weapon of mass destruction. The pitch was seductive in its simplicity. You walk into a brokerage with $1,000. The broker accepts that cash as collateral and lends you another $9,000. You now control $10,000 worth of stock. If the market rises just 20%, you have not made $200. You have made $2,000. Your initial stake is tripled. It feels like magic. It feels like intelligence. But the mathematics of margin contains a fatal asymmetry. If your $10,000 position drops by just 10%, your equity is gone. You are wiped out, and you still owe the loan plus interest. We must also investigate the dark underbelly of this leverage, a phenomenon known as the bucket shop. While wealthy gentlemen traded at legitimate brokerages, the working class was lured into these unregulated storefronts. In a bucket shop, you did not actually buy the stock. You bet on the price direction, like a horse race. The shop acted as the casino house. They knew your position, and they often manipulated the ticker feed just enough to wipe out your margin before the real price even moved. This was the democratization of ruin. It allowed the shoeshine boy and the factory worker to participate in the mania, extracting the last few dollars from the bottom of the economic pyramid to feed the beast at the top. By 1927, this was not just a niche strategy for gamblers. It was the standard operating procedure for the American middle class. Margin loans exploded from $1 billion in 1921 to over $8 billion by 1929. To put that in perspective, that $8 billion was roughly 8% of the entire US GDP. But here is the question most history books fail to ask. Where did all that money come from? Banks alone could not fund this level of insanity. The liquidity came from a shadow banking phenomenon known as the call money market. Demand for margin loans was so ravenous that brokers were willing to pay 12%, sometimes 20% interest for overnight cash. This created a perverse incentive that hollowed out the real economy. Major industrial corporations, Standard Oil, General Motors, companies that made actual products, looked at their balance sheets and made a calculation. Why invest in new factories for a 5% return when they could lend their cash to Wall Street gamblers for a risk-free 12%? By 1929, corporations were acting like unregulated banks. They were cannibalizing their own long-term growth to feed the short-term speculative fire. The economy was no longer funding production. It was funding its own addiction. Then came the final layer of the trap, the investment trusts and the pool operators. While investment trusts acted as leverage multipliers, the pool operators were the puppeteers. Men like Mike Meehan, who ran the Radio Corporation of America pool, would coordinate with other wealthy speculators to buy massive blocks of stock, trade them back and forth to create the illusion of volume and drive the price up. They called this painting the tape. The goal was to make the ticker tape, the only source of real-time information, screen with activity. Once the public, seeing the activity on the ticker tape, rushed in to buy, the pool would sell their shares at the peak. This was market manipulation on an industrial scale, completely legal at the time. The ticker tape machine itself became the heartbeat of the nation. It was installed in ocean liners, golf clubs, and speakeasies. It created a collective hypnosis. People who could not locate a factory on a map were glued to the glass dome of the ticker, believing they were connected to the pulse of the world. They were not. They were looking at the exhaust pipe of a machine designed to extract their capital. Take the Goldman Sachs Trading Corporation. Launched in late 1928, it was the Matryoshka doll of leverage. Trust A owned Trust B, which owned Trust C. Because the market was rising, the shares of these trusts traded at a massive premium, sometimes 60 or 70% above the value of the assets they actually held. Investors were paying a premium to own debt wrapped in speculation, wrapped in a brand name. By the summer of 1929, the system had become a towering engine of new era thinking. Valuations were detached from reality. The PE ratio of the market disconnected from corporate earnings. The crowd saw this complex structure and called it a perpetual wealth machine. They believed the risk had been engineered away. But a few men, those who understood the violent math of leverage, looked at the same structure and saw something else. They saw a bomb waiting for a detonator, and while the public was buying, the architects were quietly heading for the exits. While the public was intoxicated by the leverage machine, a different narrative was playing out in the private ledgers of the elite. This is stage 3, smart money exits. History often remembers the crash as a surprise. It was not. By the summer of 1929, the architects of the financial system were systematically liquidating their positions. Consider Joseph Kennedy. The popular anecdote tells us he decided to sell after receiving stock tips from a shoeshine boy. It is a charming story, but it masks the colder reality. Kennedy did not just sell because of a feeling, he sold because he understood the mathematics of forced liquidation. He knew that when the market turned, the margin calls would create a vacuum that no buyer could fill. So he did not just exit. He began building massive short positions. He was betting against the very public he had helped excite. He was not alone. Bernard Baruch, the legendary financier who advised presidents, sensed the recklessness in the air, a confidence that had crossed into religious fervor. By October, he had converted the majority of his fortune into cash and government bonds. But the most damning evidence comes from corporate insiders. Throughout 1929, executives and directors, the people who saw the real sales figures before anyone else, were unloading shares in massive. Crucially, many of these same men were publicly telling investors that business had never been better. They were engaging in fraud by omission. They were cashing out their chips while encouraging retail investors to double down. Why did the public keep buying? Because of stage 4, new era thinking. When valuations detach from reality, the market invents a new narrative to justify the insanity. In 1929, the narrative was that technology, radio, electricity, automobiles had fundamentally broken the old economic cycles. Clearly, they claimed that scientific management meant corporations could grow indefinitely. The most respected economist in America, Irving Fisher, famously declared in October 1929 that stock prices had reached what looks like a permanently high plateau. He was not lying, he was blinded by the paradigm shift. This psychological mechanism is essential to the pattern. High prices became their own justification. The logic became circular. The market is efficient, therefore, if prices are rising, they must be correct. Skepticism was treated not as caution, but as ignorance. But beneath the euphoria, the divergence had already occurred. By the third quarter of 1929, aggregate corporate profits were declining. Factory orders were falling. The real economy had rolled over months before the stock market noticed. The first crack actually came in September, known as the Babson break, when economist Roger Babson warned of a crash and the market shuddered. But the buyers returned, dismissing him as a pessimist. The price were climbing purely on momentum and belief. The gap between the price of assets and the reality of the economy had stretched to its breaking point. The system was now mathematically unstable. It did not need a catastrophe to break it. It just needed a trigger, a crack. And when that crack appeared, the violence would not be gradual. We have arrived at stage 5, the crack. It began on Thursday, October 24th. The market opened, and immediately the selling pressure was unlike anything seen before. But this was not just fear, it was a mechanical unwinding. Remember the margin loans? When prices dipped, thousands of investors hit their equity limits simultaneously. Brokers did not ask them to sell, the contracts forced them to sell. These automatic liquidations drove prices lower, which triggered the next layer of margin calls, which triggered the next wave of selling. By midday, the ticker tape, the only source of price truth, was running hours behind. This created a fog of war. Investors in Chicago or San Francisco were being wiped out, but they would not know the price of their ruin until hours after it happened. The psychological torture of the delay cannot be overstated. Imagine watching a glass tape that tells you a price from 2 hours ago, knowing that in the real room, you are already bankrupt. At 12:30 p.m., the titans of Wall Street, the heads of JP Morgan, Chase, and National City Bank, met to stop the bleeding. They pooled resources to buy stocks above market price, a desperate attempt to signal confidence. It worked for exactly one afternoon, but they were trying to fight mathematics with sentiment. Over the weekend, thousands of margin calls arrived in mailboxes across America. On Monday, the selling resumed, and on Tuesday, October 29th, Black Tuesday, the floor gave way entirely. 16 million shares changed hands. The Dow Jones did not just fall, it collapsed 12% in a single session. Investment trusts, those leveraged darlings of the new era, saw their values evaporate. Goldman Sachs Trading Corporation eventually fell from $326 to $1.75 per share. That is not a correction. That is a 99% annihilation. But the crash was just the trigger. Stage 6 is the cascade. This is the mechanism that turned a stock market correction into the Great Depression. When the smoke cleared, balance sheets were destroyed. Banks that had lent money for speculation were now holding worthless paper. When they could not collect, they stopped lending to everyone. The contagion moved from Wall Street to Main Street with terrifying speed. Between 1930 and 1933, over 10,000 American banks failed. Because there was no deposit insurance, millions of families who never owned a single share of stock lost their life savings simply because their bank collapsed. This triggered the deadliest economic force of all, debt deflation. As the money supply contracted, prices for goods fell. On the surface, cheap goods sound positive. In a debt-based economy, it is a death sentence. Imagine you borrowed $10,000 when wheat was selling high. A few years later, wheat prices have collapsed by 50%. Your debt has not changed, but you now have to sell twice as much wheat just to make the same loan payment. The real burden of your debt has doubled. This trapped the entire economy in a spiral. Farmers, businesses, and homeowners defaulted, causing more bank failures, which caused more deflation, which caused more defaults. The system did not just recess, it froze. The machinery of capitalism ground to a halt, leaving a quarter of the workforce unemployed and a nation wondering if the American experiment had failed. It took a world war to dig the world out of that hole. But today, we do not need a history book to see these mechanics. We just need to look out the window. We are not studying 1929 as history, we are studying it as prologue. Every single element of that 7-stage pattern is active in the global economy right now. Let us run the diagnostic. Stage 1, easy credit. In the 1920s, the Fed held rates at 3%. In our era, central banks held rates at 0 for over a decade. They did not just stimulate, they flooded the system. Between 2008 and 2022, the Federal Reserve printed over $8 trillion. The result? Global debt has metastasized to $315 trillion, 3 times the size of the entire global GDP. The scale of leverage today makes 1929 look like a rounding error. Stage 2. Speculation replaces investment. The investment trusts of the jazz age have been reincarnated. We see the same casino psychology in meme stocks, where companies with failing business models trade at multi-billion-dollar valuations. We see it in the crypto markets, where trillions in market value appear and vanish based on sentiment rather than cash flow. But the most dangerous parallel is the passive investing bubble. In 1929, people bought investment trusts blindly. Today, millions of investors buy index funds and ETFs without asking what price they are paying for the underlying companies. This blind capital flow distorts prices, pushing the largest companies to valuations that defy gravity. Simply because money has to go somewhere, this creates a liquidity illusion. It is easy to get in, but when the door closes, it will be impossible to get out. The call money market has been replaced by zero DTE options, 0 days to expiration. These are financial bets that expire in less than 24 hours. It is gambling distilled to its purest form, and it now dominates daily trading volume. This creates a hidden fragility. If the market moves too fast in one direction, the market makers who sell these options are forced to hedge by selling the underlying stocks, creating a feedback loop that can crash the market in minutes, not days. We must also look at the darker corner of modern finance, private credit. This is the new shadow banking system. Trillions of dollars in loans are now held by private equity firms, outside the view of regulators. Just like the corporations of 1929 acting as banks, these firms are lending to risky businesses at high rates. When the recession hits, these defaults will not show up on a bank balance sheet until it is too late. Stage 4. New era thinking. This is the most dangerous parallel. Just as Irving Fisher justified insane prices with radio and electricity, today's analysts justify them with artificial intelligence and digital transformation. They tell you valuations do not matter because AI changes everything, and just like 1929, they are half right. The technology is revolutionary, but a revolutionary technology does not justify a price-to-earnings ratio of 100. The crash of 1929 did not stop electricity from changing the world. It just bankrupted the people who overpaid for it. Stage 3. Smart money exits. The insiders are already gone. Warren Buffett is currently sitting on $325 billion in cash, the largest hoard in Berkshire Hathaway's history. He is not buying. He is waiting. Corporate insiders are selling their own stock at the fastest pace in years. Hedge funds have built historic short positions against the market. They are looking at the same data we are. They see the divergence. They see the cracks in commercial real estate, where office towers stand empty, securing trillions in bank loans that will never be repaid. They see the yen carry trade unwinding, threatening to pull liquidity out of global markets faster than central banks can react. There is another tectonic shift occurring that makes 2025 uniquely dangerous: the geopolitical exit. In 1929, the world ran on gold. In 2025, the world runs on the dollar, but confidence is splintering. Central banks around the world, particularly in the BRICS nations, are buying gold at the fastest pace since records began. They are diversifying away from U.S. treasuries. This is the ultimate vote of no confidence. It means that at the very moment the U.S. government needs to issue trillions in new debt to pay its bills, the biggest buyers are leaving the room. This creates a liquidity air pocket that could trigger a bond market collapse before the stock market even realizes what is happening. And finally, we must address the elephant in the room that did not exist in 1929: fiscal dominance. In the 1920s, the U.S. government ran a surplus. Today, the government runs a $2 trillion deficit during peacetime. The interest payments on U.S. debt now exceed the entire defense budget. This limits the Federal Reserve's ability to save the system. If they print money to save the market, they trigger hyperinflation. If they do not, the system collapses. They are trapped. Stage 5. The crack. This is where we stand today. The leverage is maxed out. The narrative is perfect. The confidence is total. But there is one critical difference between 1929 and 2025: speed. In 1999, margin calls traveled by mail. The crash took days to unfold. Today, markets run on high-frequency algorithms. When the liquidation begins, it will not happen in days. It will happen in milliseconds. Automated risk systems will trigger selling avalanches faster than any human regulator can unplug the machine. The gap down will be instantaneous. The stage is set. The actors are in place. The script has been written. The only thing missing is the spark. And when that spark strikes, you need to know exactly where you stand. The market does not care about your retirement plan. It does not care about fairness. It does not care about your political ideology. It only cares about liquidity. And right now, the mathematics of liquidity are flashing red. We have walked through the 7 stages. We have seen the evidence. The trap of cheap money was set years ago. The leverage machine has been running at maximum capacity. The divergence between price and value is absolute. Remember the lesson of Joseph Kennedy. He did not try to save the market. He did not try to warn the shoeshine boy. He simply looked at the math, realized the game was rigged, and quietly left the table before the house turned on the lights. The smart money has already made its move. They are watching from the sidelines while the crowd continues to bet on a permanent winning streak. The crash, when it arrives, will not be an accident. It is the inevitable clearing of a system that has forgotten the price of risk. We are in stage 5. The window for preparation is closing. The clock is ticking. The The question is no longer if it happens. The only question left is, will you be standing when the dust settles?
The shorts are accelerating. Execute the trade.